lecture. So the topic that we're talking about is investment for startups. There's many different aspects to raising money for startups. I've got a bunch of slides which I can share with you afterwards. Don't worry about that. You're more than welcome to take screenshots or anything you want if it helps you. And as Lucy said, you'll be getting access to a copy of the recording. So my first question I want to get a feel for, have any of you raised any money before for startups, done any equity raising? Okay. Stefan's just about trying
I did, but that was a long time ago in different circumstances.
Okay. And before I worry about how, I think I want to have a conversation around the implications of raising equity fundraising, because I think a lot of entrepreneurs forget that. And so the first thing I want you to consider is, if you raise equity, which means you are selling part of your company to somebody else in return for money, you have just given somebody else the right to have an opinion about your company that you need to engage with. And it doesn't mean that they're writing that opinion for what it's worth, because in some of my past startups, I would argue they were wrong, though to be fair to them, the investors would argue they were right. And that brings attention. So how do people feel about the whole idea of having somebody else who can decide things like what your wage might be, who can decide things like what products the company might want to sell or might not want to, or want to create, and fundamentally have a big say in the strategy of that company? Any thoughts around that? Anybody?
Wait, Cleantha, you haven't got a very clear line.
Not happy about. Oh, sorry.
That's all right. Oh, that's better.
Can you hear now? Yeah. I would feel worried by that because being self-employed and an entrepreneur means that it's your creativity and your independence, especially at the start, would be important to me. So the idea of somebody else would be a bit like being employed again.
Yeah, and you're completely right at times. And arguably, in reality, you are employed by the company that they own part of. Yeah. And it does change that relationship from self-employed sole trader, you know, definitely top of the pyramid, to being an employee. And, you know, there's nothing wrong with it. It's just being mindful of it.
Ian, the other thing that I would observe is, and I mean, I'm not hugely experienced in this realm. I've never actually raised finance myself, but I've been in the environs of it. Is that it's not just the decisions themselves; it's also the noise around things. Which, I mean, I think, you know, I would say that's probably the most negative thing I've seen, just the sheer amount of thought time and effort in terms of, you know, interacting with investors. So, yeah, I mean, I think it's, yeah, from my observations, very important call out. Yeah.
Yeah, and you know, they are almost as much curating as having an employee in the company that isn't quite performing. You know, it's not a great employee who you just leave to themselves. It's like dealing with an employee who wasn't quite on their game, and you've got to talk to them, check that they're aligned, especially early stage companies for most of us, because that's where the most risk is. And then
I mean, just from my perspective as well, I mean, part of the reason that we didn't list as a kind of a commercial organization is because the needs of the people that we're serving are our members. And I thought, well, you know, we don't really want to be beholden to a mortgage company or an equity release company or a travel and tourism business to push or pump a particular message. So, you know, our structure is a little bit more, let's get owned by our members, because if we're serving their needs, then we're going to have, hopefully, the impact in the right way. And I see a lot of organizations in this space that are basically, I don't know, selling things that the shareholders want them to push, or the messages, and I think that's a bit of a conflict.
Yeah, definitely. Now the next big thing it's directly related to that is, if you take on board an investor, more than 90% of the time they will want to sell your company in about 5 to 10 years time, which will mean probably the end of your involvement with that organization, because you'll get bought by a new organization. They'll probably keep you for up to 12, 24 months, and then they'll just gently fade you out. And so that's another emotional shock that some people need to come to grips with. But actually, there's another important element of that is, I would argue, before you go for investment, the best question you can ask yourself is, who will want to buy my company in 5 years' time and why? Because the investor is looking to buy your company so they can sell it. There was a question coming up in the chat window. Let's see what that is. Ah, that's okay. They want to sell your company in, say, 5 to 10 years' time. And if you're going to go to investment, the easiest way, I believe, in ensuring that you're successful is by being able to tell that story to the investors that says, we will be bought by this company in about 7 years' time when we look like this. And that's quite a complicated story, because you might say, we'll be bought by somebody else in our supply chain, but the sort of questions you need to be answering is, well, what turnover would that acquiring company want to buy? Because if your company doesn't make a big enough difference to their revenue, they're probably not going to buy you. So if you're looking at a classic case, people might say, oh, Google, IBM might buy us. And you're going, well, that makes life a lot harder, because they need 100 million, 200 million pounds worth of revenue before you're interesting. If you look for somebody, and so if you want to build that perfect story, I always say, start at the destination, understand where you need to be in 5 to 7 years' time in terms of headcount, market penetration, and the money you need to get there. And then you can start at the beginning saying how much money you want to collect today. Does that make sense? Mm. Cool. So, and then another key thing I want you to take on board is, we're going to be meeting these people many times over the next few months. I say, before the call started, we were having a conversation around weddings that we've just been to. And I will say, it's a bit like a first date. You can ask for many things on a first date, and some of them are a lot of fun. But generally speaking, people who go asking for marriage on the first day find the conversation quite short. And in the same way, if you engage with investors and fixate on, will you invest in me? You tend to see them walking away because you're asking for too much commitment from them earlier on. And so at the beginning, we're using light touch, short conversations to sort of get our credibility, to spend more time talking later. And then we can put in the complexity. And you have to be kind of comfortable on, when do I start sharing this complexity? Because investors will trust you until they don't trust you. It's a great truism. So you can delay the complicated conversations, but never completely avoid them. Another question for you all. If you was asked, how much time would you like to talk to an investor to tell them your idea? What sort of time do you think you would like?
Well, I'm going to imagine you're going to want as much time as possible, but you're going to get about 5 minutes.
Okay, thank you. Great answer, Ian. Any other answers?
It depends on who they are, right? Like, if they've got valuable input all day, every day, I'm happy to chat to them. Well, maybe not all day, but you know what I mean?
No, that's very true. And I think, so the actual answer for me is, I can confidently say that I can tell any investment story in less than 7 minutes if I'm in a broadcast mode, like I'm on a stage speaking to people. And I would normally say you want about 5 to 7 minutes. But the best conversations are when it's a Q&A session, as Ian said, and then you'd be looking at half an hour to an hour. But your presentation material should be about 5 minutes long. Because we're halfway through this journey, where the journey starts at one end of find investor, get to know them. We're in the middle, which is show them that it's worth doing due diligence. Due diligence is where they spend a couple of days to a few weeks to a couple of months doing a deep dive. And so all you're trying to achieve at this stage is permission for them to spend a day with you. So it's 5 minutes conversation. I'm now going to go through what I think is a good investor deck. This is a little bit tongue-in-cheek, but I want you to imagine you have a spare £1 million. A few years ago, a couple of academics from one of our universities both left the university with £40 million in their bank account after their startup was successful.
Wow.
And so I want you to imagine that you're one of these entrepreneurs and you've got £40 million in your bank account. It's 6 months later. You've paid the bills. You've sorted out your children and grandchildren, etc. One morning you've turned over to your nearest and dearest, and trust me, I don't know how bad you are at dating, but with 40 million in the bank after 6 months, there will be a nearest and dearest if that's what you want. And I want you to tell that nearest and dearest how you're going to spend £1 million for fun. What do you buy yourself for £1 million?
You ask, okay.
Yeah.
Is that a million that is completely disposable after?
Completely disposable. Not, you don't need to fix it. It is just £1 million for you to enjoy.
Okay, I'd probably invest 80% long term and
That's
keep
the
20.
39 million, remember. This is the
Yeah.
1%, so, you know, this is completely disposable.
Sorry, what is the relevance of the 40 million? Maybe I'm confused.
I'm just painting a story. I'm trying to say the 39 million's dealing with life. So you've got 1 million for yourself. Anybody want to buy a fast car, buy a yacht, buy a round the world trip?
That I'd be going down the route of, well, I would definitely go down the route of holidays and experiences. So I'd probably have a whacking great party and invite everyone to it. I'd definitely do a bit of like serious luxury travel. So stay in the best hotels. I'd do first class. I've never traveled first class, barely ever traveled business class. So I'd quite like to do some of that, spoil myself a bit, I think would be mine.
I mean, I'm slightly worried about the fact that I have got through 40 million, to be completely. I think that's the bit of the question that's throwing me slightly. Because I know that if I made 40 million, that dealing with all the kind of, my grandchildren, etc., wouldn't take the entire 40. And so I'd be looking at the 40 going, I'd like 20 of that to go into investments and 20 to be fun and family and whatever. Yeah. If I'm left with one, I'm kind of going, God, I'm burning through this a bit.
No, you hadn't.
Genuinely the last one, then I would definitely want to be investing it, I think.
It's not the last one. It's your disposable one. Anyway, so the point I was trying to make was think of the sales and marketing material of these products and services that you will be touching. Think of the imagery. Think of the fact there are no spelling mistakes. Think about the fact that the story is consistent. Too many pitch decks, when they turn up for me to look at, look like they were done on the train to the meeting.
No.
They were, yeah, they do. They were too
many.
Because they are done on the train to the meeting. And you speak to these entrepreneurs and they quite rightly say, but I'm busy, Ian, trying to find customers. And I'm saying, yeah, but from the investor's point of view, your pitch deck is the first time they see your sales and marketing capability. And so it needs to look slick. It needs to look polished. It needs to be sent. Don't go crazy. So when we first set up Anchored In, we spent about £500 getting a full branding pack done, which was logos and templates. You can do it even cheaper now through Fiverr. That's a great way of getting it's like £30–40 for a sensible pack. So just make sure you look polished. That's all I was trying to say. Now let's go back to the slides. These are the 12 essential slides that I believe you need for a good investment deck. There are many, many different decks out there, and people have different points of view and they might be slightly different. It doesn't matter. But I will say that 80% of all decks will have 80% of these slides somewhere, and you can do these slides in about 5 to 7 minutes. That's only 30 seconds per slide if you do the numbers. But that's okay, because we're not trying to convince anybody. All we're trying to do is have a conversation with them. These are conversation starters. So let's go through these slides and I'll explain how they work together. Yeah, the hard-hitting ones, people, traction, finances, and I'll explain why. The title slide's on the screen while the room's getting ready, if it's an old-fashioned meeting room or a Zoom room. And if you're emailing it over, it'll be the first slide that gets read. I'm also going to say you should really have 2 decks. One is an email deck that you can read by itself that will have the same images, but lots more text, so it's a document. And the other one will be your presentation deck that you'll be putting on a screen where there are no paragraph text, it's just the headline. Because if you think about it, the product is you, not the presentation. But by keeping the same images, you give people that ability to flick back and forward between the two presentations. On your title slide, I don't need your contact details. I barely need your name. I need the company name. But think about a powerful sentence you might want to put there, transforming the world through, or putting down, or if you've got a few big customers, as used by IBM, something like that that's going to get my interest. Then I would open with a 30-second elevator pitch. We've done the elevator pitch in other workshops, but if people want, I can quickly run through it at the end of this one. And that just gives people a quick introduction of what the presentation's about, who you are, and you've allowed people to zone in and focus. If you're in a classic presentation room, demo day as they call it, you might find there's 20 companies. Investors might only want to listen to the 5 that are most interesting to them that day. So the elevator pitch is your way of waking them up. Now, personally, I would go next onto the product or the widget, because I like to encourage people to think that from the investor's point of view, the product is the stock in your company. The widget is the thing that you sell your customers. Is there anybody in the room who has such a joy about their product that they might unfortunately talk for 4 minutes if they're not careful out of the 5? Because, you know, yes, thank you, Lucy. Most of us are like that. If you're that type of person, you might want to put your product slide to the end, so that you can do the important ones like team and finances before you run out of time. If you're on a stage, your time allocation of 5, 6, 7 minutes is probably going to be curated hard. If you're in one-to-one meetings, it's not too bad. But if you need to, perhaps move that to the back. Then I want to see how you make money from your customers. This should include things like the cost of acquiring them, customer acquisition cost. If you know how long the customers will stay with you, and you can do things like LTV, lifetime value, that's great. And what you're trying to do on this slide is show the investors that you know how your company is going to make money. Then traction, and this is where you're answering the question, other people believe in your product. So the best form of traction is going to be product sales, as easy as that. And after that, you might want to look at things like part paid product sales, or you might want to look at a memorandum of understanding with a blue chip company. I discount free products because it's easy for people to take products off you for free. It doesn't mean they've engaged with you. And so I would always, so if you go for an MOU, which has 0 legal value, it means that a large organization has pushed it through the legal department. And so there's an acquisition cost there from the other side, which is more expensive to them than accepting free product. I would then go to the market, and this is where you're showing me that you really understand where the money is. There are 2 ways of doing the market. This is the classic top-down. This is an MBA classic. I don't know what reunion you're going to, Stefan, but if it was an MBA reunion, this is the sort of stuff we get taught at business schools. This is a real slide from when I was at STFC trying to do a hydrogen startup in 2012. The numbers are fairly right from 2012 from memory. The automotive market is 1.7 trillion, fuel systems are 58 billion, fuel tanks are 17 billion, and with a 15% market share within 10 years, we hope to be a 2.5 billion turnover company. Now, the background to this project is we built a material that was going to allow BMW to convert their petrol cars into hydrogen cars. And this was before they invested in the electric platforms. And if you think back to the Olympics in 2012, BMW was running a hydrogen taxi service because it was a low-cost way of transitioning to a clean economy. But the key point from us, there's probably 2 numbers that stick out to you on that slide. Would anybody like to guess what the 2 numbers that might be sticking out to them? One of them is extremely large.
The 1.7 trillion and the 15% probably.
The 15% definitely. People say, why 15%? Well, what I'm going to tell you is whenever somebody tells me with a 1% market share, I will always say, so 99% of your marketing effort is wasted. If you only want one, you should be marketing a group that is tight every mature marketplace that I can think of has 4 to 6 major suppliers and then a lot of noise. Think of car companies, think of washing machines, think of holiday companies. There's 4 to 6 major suppliers. So I did 100 divided by 6 and kind of got to 15. So I want to be one of the major 6. So that's where the 15% market share from. And then the other big number, of course, coming from the 70 is 2.5 billion. How many of you can expect a company to be worth 2.5 billion, doing 2.5 billion into it's not believable, right? That isn't defendable, which is why people traditionally would be attacking the market share to bring it down to a number that they believe is. But I hate these approach. Hate's a strong word, but it's close to the emotion I have.
So Ian,
yeah.
Sorry to interrupt, but so you're going back to your kind of point about quality and credibility and whatever.
Yeah.
I mean, if on this slide, the trillion number, I think, was in pounds.
Well spotted.
And then we go into dollars, and then we go into a 2.5 billion without any currency against it. I mean,
yeah.
For me, it fails at that point.
Yeah, I was much younger then.
Oh, sorry, I wasn't trying, but I mean, that's like it's like, so what, we're like 2.5.
Spot on. Spot on.
What are they?
Yeah, there's that attention to detail. So the different currency units would have been different market research reports I would have picked up. Which I don't know if those tiny URLs work 10 years later. But those tiny URLs were connections through to market research reports that I used to validate the numbers.
Mm-hmm.
But as a slide, that is really not good.
But yeah, you're talking methodology, not detail. Yeah.
The better way of doing this slide for me is what we call a bottom-up market approach. I'm guessing, well, I've not checked, but I'm guessing none of you come from the automotive sector. But the bottom-up approach says our hydrogen fuel tank costs £100 a fuel tank. I have absolutely no clue what the cost of a fuel tank is for a BMW 5 Series, but £100 doesn't scare me at the factory. It's completely believable. The total number of cars made last year was in 2011, sorry, last year in 2011 is 68 million. So the total market is 6.8 billion. And with a 15% market share, our turnover in 10 years' time could be £1 billion. Now, 1 billion is still a huge number, but at least there's a conversation there that you can have about, is that 1 billion real? There's actually still one mistake on this slide, is I did all cars in the globe. In reality, if I did European family cars, because we were talking to BMW as our prime customer, and let's just make my mathematics a little bit easy for me today and say, let's pretend it was 6.8 million cars being made in Europe rather than 68 in the globe. Instead of having 1 billion turnover in 10 years' time, I could have 100 million turnover in 10 years' time. Still impressive, but it is the sort of story where somebody goes, okay, if it works well, I get it. And that leads me to another point.
Yeah, Ian, sorry. I mean, I know apologies if I'm being
I'm loving it.
But
I love it.
I'm loving it.
The first slide you showed us was a market size, which kind of by definition is a what is being sold on a price times volume number. That slide you've just shown us is a cost number. So your billion of cost is relating to the 2.5 whatever of revenue. So actually, I mean, you've
sorry.
The point is, my main point is you should be covering that, right? You should be covering, it's going to cost us a certain amount, we think at the size we're talking about being, and then we're talking about a profit margin which is huge or a sliver, which is an important part of the story.
I don't think it's a cost number in the sense that it is the cost to produce for us. I think it's the cost.
Exactly.
It's a product that you're selling, and the cost for the customer would be £100 per unit.
Yes. Stefan's right. Again, okay, the slide, it was the sales price to BMW, which is the cost.
Okay, all right.
I think, looking at those two, I mean, there are a lot of people actually in the market now, they don't really like I mean, it's traditional to show the total addressable market, but they don't
Sam
really
and Tom,
like it.
I hate them. Yeah.
They do like it. So you have tons of opinions, you know, across the spectrum. I think what established credibility is that you do the analysis both ways and you try to triangulate your numbers so that you can, you know, you're solid in terms of your assumptions. They're challengeable. Everything is challengeable, but at least you're solid on the assumptions and it starts the conversations because they might believe in the product, they might not necessarily believe in the addressable market. And as you said, it could be $1 billion of revenues in 10 years, or it could be 100 million. That's still an interesting proposition, no matter what, because people don't care about actually the numbers if they're looking at the long term. They know that, you know, your business projections are not going to be there. No way. One way or the other, up or down. But those are not the numbers. Those are just an idea, an aspiration. But at least it starts the conversation.
I agree completely with Stefan, sorry, completely. I'm also going to say, Stefan, what adds credibility on this slide is when they start challenging it and you're able to quote people across your whole supply chain and sort of say, well, such and such a person told me this, that's why I picked £100.
Agreed, yeah.
Yeah, and this slide is one of the important slides because it shows you that you know where the money's coming from. And to reflect upon what Sarah said, there will be questions that follow on. Well, if you're selling it for £100, what is the cost to manufacture? But it won't be on this slide, Sarah.
No, fair enough, understood, yeah.
And if you can reinforce all these points by third-party conversations, I think you're way better than most. I think a lot of people don't answer this question when they go to investors. There's another school of thought that says for seed companies, you don't need to answer this question because the assumptions are very difficult to defend. But then I think what you're doing is you're forcing the investor to supply optimism for your idea. And I think you should supply defendable optimism, which means you piece together a story and then you take the challenge from the investors that might be, well, why 10%? Why 17 million cars or 6.8 million cars? And it's for you to defend that optimism. And then in reality, the error bar at 5 years' time could be 75% of the number in either direction.
Yeah. Just another quick, almost like a question from the kind of maybe the non-profit school. This deck and what you're sharing, how relevant is that for people pitching for grant funding?
So the market sizing one you would use. You would use it for your impact. You don't get asked to pitch an investor deck for most of the grants that I've worked with. But that might be changing. There are some calls like investor partnerships, which are grant plus investor, and then you will need a deck. And this is the deck that we use at Innovate UK.
Yeah. Okay, thanks.
Returning to the slides. Then competition. Your biggest competitor is do nothing. And a lack of competition shows us, unfortunately, that the customer base has not got budget allocated to buy your product. So when you start hearing things like, nobody else is doing this, you should be able to explain where the money is being spent today to deal with this problem. And if the money isn't being spent today to deal with this problem, you've got a real difficult journey taking a product to the market. And that will put off many investors, if not most. So this is a classic Boston Consulting Group 2x2 matrix. It's used a lot. And good is in top right because that's where good is. So what we've done on this chart, we've had to play with the price by putting affordable at the top and expensive underneath, just to put good top right. It is tradition that that's where good goes. The other way of doing a competition matrix is a table, feature table. It's always suspicious when you're the only one that's 100% ticks. And so on this one, I've kind of cheated with a star product again. I've said that we lack installed base, but we're going to use the investment cash to grow our sales and marketing effort. An advantage of the previous slide is you can use it to start talking about your exit story by talking about other competitors over why they might buy you. So in this example, company C might buy your star product because they want to cost reduce. They're both online, but C is expensive or different demographic. or D might want to buy the star product because they're an offline company and they're looking for an online solution at the same price point. So that's one of the advantages of using the 2x2 Boston Consulting Group matrix.
But the previous slide, the one with this one is so much easier. It's a snapshot where you can just get a picture of that in your mind really quickly and understand that. Whereas the matrix, you've actually got to sit and study. Whereas this, you've got to put your reference points in. Whereas the second slide that you showed is much bang. Okay, well, we're on.
I agree. I think they do slightly different things. There's a lot more detail sitting in here on a feature comparison. I think the challenge you have with this one is you've reduced it to 2 dimensions because it's a 2-dimensional chart.
Yeah.
But if you pick the right 2 dimensions, you've gone up an abstraction level and you've got a lot more knowledge on the table. If you pick the wrong dimensions, you learn nothing, right? Whereas it's a lot easier doing a table.
Yeah.
I suppose it's a question of the competitors' universe and the depths of it. If you have lots of competitors, maybe the matrix works better because you can sort of see, you know, the groups and the groups of competitors where they sit. If you do feature comparison, you cannot put, you know, 25 people because of those. It's going to be completely crowded and pointless at the end for the conversation. You want to select, you know, your closest competitors at that point.
Yes, and you might group companies together.
Yeah.
Which is another way. And
then exactly, by categories. I agree. Yeah.
And then another way of doing it, which I really don't recommend using, is the sunflower diagram, where you're at the center and you're sort of showing how you fit in the ecosystem. You might want to do this as a Q&A slide to use at the end of your presentation, but I'll never put it on the screen because most investors look at it and go, well, that's beautiful, but what on earth is it trying to tell me? And you know, you lose the room as they try to decode your slide. So that's never a good thing in my life. Some people love it for Q&A because you can have a conversation around the petals. I believe the team slide is the most important slide you have for early stage companies. And that's because of a truism. An A-class team will make a success of your project, or they will go off and do other things because they have opportunity. Whereas a B-class team will spend all your money and leave you none the wiser. That's how the saying goes. And for most early stage companies, the team slide is the only thing that they can excel at. It sounds a bit harsh, but you know, the product yet isn't into market. They don't have, you know what I mean? Whereas the team has a legacy, has a past, everything else on the deck tends to be forward optimism. And so for me, the team slide is the most important slide because it shows me that you've got an A-class team and you're likely to make it work or move on. It's not just the people you employ, but it includes your non-exec directors, it includes your science advisory board and all that sort of stuff. Another big thing you get out of your team slide is it shows me your capability and respect in a marketplace. So let's say you're selling an educational product and you happen to have a former vice chancellor of a well-known university who's sitting as your chairperson. You have to believe that that former vice chancellor of some well-known university knows the marketplace and knows that you've got a great product. And also you've been able to articulate to that person that your idea is one that's worth backing. So you get many sort of aspects out of the depth of a good team slide. Heads up, Sarah, you're not going to like the next slide because it's a visualization rather than a reality, okay? But I'm going to tell you now, just so before we get there. Then your finances slide should not look like this at all for what it's worth, but you should be looking at about 3 to 5 years forward finances. More than 5 is arguably just too much of a daydream. Less than 3 isn't enough runway. And we'd be looking for things like expected revenue, expected costs, gross profit, break even, and any key metrics like subscribers and conversion rates on your finances slide. Please don't do the chart on the right-hand side. Invariably, in my experience, charts like the right-hand side have been done by the engineers trying to do finance. because the engineers love seeing the trend. And this is a sweeping generalization. Finance people will get hung up on year 2 and they'll say the blue dot, is that 10, 11, 9.5? And they don't like that they do not enjoy the lack of precision. Whereas when they see it as a table, they know exactly the number and they can draw the trend curves in their own head so quickly because they do it all the time. There's an interesting debate about how much rounding to do. Some people, when they look at the finance chart, love it when they see the numbers not rounded because they feel it shows the model. Other people prefer them to be sensibly rounded, as in 100,000s, half millions, millions, and whatnot. If you are going to round your numbers, please make sure that the total function is still correct. Otherwise, you'll see 450 rounded to 500, 450 rounded to 500, adding them up to 900,000. And again, the finance people find that really difficult to cope with. So just double check your totals. Ian, you look like you're going to say something.
And this is from a previous life of mine where I used to do corporate events all the time and have to tidy up people's PowerPoint slides. But some of this, where the spacing is slightly off, is really driving me slightly mad here. Because it's that there's been a couple of the slides where some things haven't been lined up and stuff like that, and it's been drawing my attention. I think that's just my brain. Where I'm actually...
You've illustrated a beautiful point, how these little details do get your attention for all the wrong reasons.
Yeah, and that's why I was going to say, because the spacing on your year 4 is that one, and then on the one with the round with the car, the arrow wasn't straight, and it's just these things that pull my eye, and I guess, as you say, people fixate on them, and they're looking at that rather than necessarily the other things. So sorry, it's just a pet peeve because I used to tidy up people's slides for
No, you've illustrated another point for free. That reflects back to the beginning of the £1 million. And these slides are more abstract interpretations rather than real slides.
Yeah.
So
it's just the thing that gets me whenever I see other people's slides. I'm like, oh God, tidy it up, takes 2 minutes. Sorry.
No, you're completely right. About a quarter of the decks I get to see don't have an ask, which I find somewhat unbelievable. But the reason why they don't have an ask is because people are still trying to figure out how much money the investors are prepared to give. So they tend to skip the slide, trying to keep it agile. A decent ask slide will say, how much money do you want? What change will it make to your metrics? And what change will it make to your revenue? And then exit strategy. As I said, this is this is a contentious topic for some. In reality, there are 3 main ways: initial public offering, trade sale, or revenue distribution, dividends. For an investment opportunity, you don't want to do dividends because they're not tax effective in the UK. It's tax effective is done by either flotation through an IPO, initial public offering, or trade sale, and then just look at the raw numbers. If you don't have a solid exit strategy in your mind, I'm just going to share with you, it's something like 93% of all companies, successful companies, exit through acquisition compared to IPO. So you're 9 times more likely to be correct if you just say trade sale and describe a trade sale in the absence of not knowing. But if you are going to talk about, you should really be saying who will buy you at what stage and why, and that'll separate you from the average and the grey.
Wow.
And then finally, the last slide is your closing slide before you get to Q&A, and that's where I would put my contact details. Because that's where you can see that then I might be interested in knowing more. And then we would go to Q&A, which is where I'm going to go now. And thoughts so far?
I think it's so useful. So anyway, I won't say anything.
And this is more about the content of the slide themselves. I've often, and it goes back to my previous life when I was doing this, tidying up all those PowerPoints that were done on trains on the way down to the event. The information on the slide should be what you shouldn't be reading the slide out to the people. It should be a case of this is a presentation of here's a bunch of facts, and then I'm going to talk around those, rather than having a slide that you're essentially just reading to people.
Correct.
A number of people that I've sat and watched at the back of a conference room whilst I'm falling asleep, doing a sound desk, where they're just literally reading a PowerPoint to you is insane.
And that's where they're using the PowerPoint as the prompt cards, as their script. So they're using the PowerPoint as a script card rather than a prompt card. There'll be a little difference between the two. And then that's why I said you should have two decks, one that is basically just the headings and the same pictures, and the other one that might have the paragraphs that you articulate.
Yeah. That's really sensible.
So Ian, I think what would be helpful to me is a couple of aspects. First of all, this is like very kind of heavily focused on equity.
Yes.
Can you just kind of run through like the alternatives that you'd consider before going down that track? I mean, the implications thing was like loud and clear, but you can go and get a loan, or you can go and get a grant. So there are other things that you could do. So if you could just kind of give a bit of a kind of an idea of the landscape there, and the other thing is in the equity world, to kind of talk through the kind of angel investors versus VC versus PE, et cetera, the kind of the kind of ladder of different levels of parties.
Sure. So I'll do the first question first. The alternatives about equity raising, I was going to say grants. There are some grants. Grants tend to be, you get small grants organised by region, and there's might be £5,000. They tend to be 100% grants. Larger grants tend to be driven by an innovation need, and they would be part funded. So you might need to find a third of the grant and the government puts in 2/3. There are some other large grants in the outer regions, i.e. Scotland, Wales, Northern Ireland, which are for job relocation. So build a factory over here. And again, they will tend to be part funded. And so often you'll see people doing an equity raise, a fundraise, against those grants to get the match. And you'll be selling to the investors a multiplier. We've got 2/3 coming in from Scottish Enterprise, and we want a third from you to fund our factory. So that's quite typical. On the banks are generally considered not very supportive, only because they manage risk very well. They manage risk extremely well. So the exceptions to this would be, you've got the Startup Loans Company, there's two of them, Virgin is one and Startup Loans is another. That's a product supplied by British Business Bank through these two chosen intermediaries. And they will lend you up to £25,000 per director to a maximum of 4 directors at sensible rates. So that could be £100,000 to get you going. There is another innovation loan product from Innovate UK, which is accessible to companies taking innovations to market. And if you've got a turnover, you will typically find online banks willing to lend you, depending on the sector, depending on how long you've been going, depending on how profitable you are, 25 to 40% of the last year's turnover to fund growth and expansion. So if you have a real business that has got some money, that could be an equity-free way of growing, is what I'm trying to say. And if we go back to, I know many people don't like loans because of the whole concept they need to be repaid, and they think, well, if I have an investor, I only pay them if I'm successful. The classic story is an investor wants to multiply their money by 10, and let's say in 7 years. If you borrowed some money from somebody and you had to pay back 10 times much in 7 years' time, you'd be describing them as a loan shark.
Yeah.
And so investment is actually really expensive money that people don't always appreciate. And then the final way of funding your company that I can think of is good old-fashioned sales. We sometimes forget that retained profit from previous jobs is the most cost-effective way for many companies. It might limit your growth. That's the price you're going to pay for it. But you can think of doing things like consultancy to augment the sort of work that you're doing in your product. And consultancy sales, for what it's worth, for early stage companies, as long as it's not too much, is a good way of indicating to investors that you're respected in the marketplace and you've got connections, and that's why your product's going to work. Sarah, there was question 2, which I've managed to forget in the joy of answering question 1. What was question 2?
No, thank you, Ian. That's great. The second one was on the equity side, the different kinds of investors, you know, from angel to VC, etc.
So it's known as the equity escalator is another way of looking at it. And broadly put, and I'll put a slide in the deck that I sent out, but I won't find it now to save time. If you invest early, you're going to do two things. You're going to put less money on the table because the risk is higher, broadly speaking, and you're going to want a bigger return for that money going on because the risk is higher. The first investors that come on are going to be the informal people that you know, which is friends and family. So these are people that are investing in you because they know you. You might share with them a business plan, but in reality, they're backing you as the individual. If you take any money from friends and family, you'll be very tempted, and understandably so, not to do a full contract. You know, if your parents put £50,000 pre-inheritance to you, very few of us are going to say, thanks, mum and dad, but here's the contract for you to sign for me to acknowledge it, because mum and dad will be going, you should be grateful you got the 50K, sunshine. In those sort of situations, I would urge you to do a thank you email. So if something happens in the future, you have something that can say, it always was a gift. It always was a loan. It always was. Because I've also known people who think it's a loan when the company's gone bankrupt and want it, but also do that if it's friends and family. Informally, there's the third F is fools, which isn't the most polite because you're only a fool if you don't know the person to back the individual. After that, you'll get business angels. These are individual folks who are investing personal cash. Typically, lowest number £5,000, typically £50,000 to £100,000 per person. Round size, collectively 250 up to £1 million in extreme cases. This is the first formal round. They get special tax breaks, which you may have heard of, called SEIS and EIS. They just give some money back, but the investors want it, but no investor invests because of the tax break. The tax break is there for tax-free profit extraction. So you still need to show you're a good opportunity. After that, you'll get angel groups, which is more than one angel coming together. And after that, you will get venture capital, which is people investing other people's money. The big difference between the two is when they're investing other people's money, due diligence tends to be more systematic and consistent between the deals that they look at. Whereas when it's angels, due diligence is the sanity checking process that you're worth the investment, is very, very varied. I've known people to pass due diligence while walking their dogs together. And I've also known due diligence that goes on for months because they are treating it like it's the last £5,000 of their grandchildren's inheritance. Stuff above venture capital, I'm leaving out of this talk because by the time you get to that stage, you should be sensible enough to know the answer.
Yep.
Fair enough.
There's a whole conversation around valuations. This is stupidly obsessive, understandably, not stupidly, sorry. It's quite obsessive for many people. The only three bits of advice, a valuation's worth nothing until a check's been passed over and cashed. Until then, it is just aspirations of the future. And the other piece is if you go to Seed Legals, they publish the data for the deals that they've done in the last year. There's two peaks. One peak is around 3%, which is friends and family, I believe, who are overvaluing your company through generosity. The second peak is 15%. So if you don't have an answer, the rough and ready rule to use is 18 to 24 months activity for 15% of your company. If you want a better answer than that, a more defendable answer for that, use Google and search up basic VC valuation models. And there's a model that will tell you how to do it. And that's driven by the exit story. There's about 10 different models that are easily accessible, but I'm just picking the 2 or 3 that are easy to explain to investors in the early stage.
When you say 18 to 24 months of activity,
Yeah.
what does that mean? Are you just sort of talking revenue times?
I can do, 18 months runway, 18 months cash flow. So if you, keeping it super simple, if your company is spending 20,000 a month and you're predicting 10,000 a month in sales, you've got £10,000 a month for 18 months that you need to find 180,000. Obviously, the curve is not going to be a straight line like that because sales will be growing and the team will be growing, but I'm not going to do non-linear calculations in my head without Excel.
Okay.
Lovely, thank you.
People get very hung up over valuations because they think about the part of the company that they're going to keep when the exit happens. I've seen deals break because of this. If you're really passionate and you can't quite close the deal, you're almost there with the investors, but not quite. Don't be afraid to put stock options against performance, which will bring back the valuations to where you should be. So I can see Ian and Sarah are both thinking Stefan's really good at playing cards, is the conclusion I've come to. If one of you's saying 15%, one of you's saying 20%, you structure a deal that says, if I hit this milestone, I'll get 1% back. If I hit that milestone, so if you deliver the business plan, they would have valued 20%. They would have taken 15% because they've given back 5% over 5 different milestones. That can be a good way of closing the gap if you're almost there, but it's just valuation that's stopping you.
Yeah. You see that a lot of the time on Dragon's Den.
You do. Outrageous valuations on Dragon's Den, but you do get TV publicity, which partly defends it.
Brilliant. Anything final questions to wrap up? Just so informative. Thank you, Ian. I found that really useful, super interesting. And as always, just your time is very much appreciated. And appreciate as well the generosity with sharing the recording.